Hi and welcome back. So this time we're going to flip around from being investors to being companies. So far we've kind of looked at what stocks can return for us and what the present value of stocks are, and that's coming from an investor point of view. But the next couple of chapters, and kind of basically the whole final, has to do with kind of taking a look at finance from a corporate finance perspective. And the first thing that we need to think about here is the capital structure and cost of capital. So let's just write cost of capital here, because that is really what the upcoming videos are going to be about. And the first thing that I'd like to impart here with you is that the key concept and the key skills really are based upon the foundation that, like we've said several times, that a company raises capital through both debt and equity. So when they do this, they obviously can't do it for free. When they issue equity, they're giving away perhaps a common dividend or a preferred dividend. They're also giving away ownership in the business. When companies are issuing debt, they're paying an interest rate. So it's when they borrow from the bank, they have to pay some type of interest rate. So there is a cost of capital to the company. So the idea of this, this part of the course is kind of to know how to determine a firm's cost of debt, then to know how to determine a firm's cost of equity, and then kind of blend those two together, and then we end up with a firm's overall cost of capital. So there are basically four types. The first type is just the cost of debt, and that would refer to a bank loan or bonds, and the cost of the company obviously is in the way of paying interest on those those securities, those types of raising capital. The second is the cost of preferred stock. So if the company decide to issue preferred stock, they're going to have to pay some type of dividend on that, and that dividend is obviously a cost to them. Number three is going to be the cost of issuing common stock. And then the fourth way is the cost of retained earnings. And sometimes this gets a little tricky in terms of intuition, because the first question students usually ask is, one sec, cost of retained earnings? I mean, they're keeping the money, so then why does that have a cost? And over the years, I've basically found that there's two ways to explain the cost of retained earnings. The first way is basically trying to think about it from this vantage point, that the cost of retained earnings, the cost of the company of holding their earnings back and reinvesting them back into the company, are essentially the returns that investors expect from the company's reinvestment back into the company. So that's it's kind of like the opportunity cost. The opportunity cost, I would say, of investing elsewhere, because they could have taken that money, investing in another company. They could have taken that money that they reinvested back into their own company and just bought shares in another company, which companies quite often do. And I would say the second way to think about it is pretty similar to the first way, but I'm just trying to give you two different angles here. The second way to think about it is basically the opportunity cost of not buying back their own stock, and then earning dividends on those shares, which is quite interesting. So if you imagine a company, so again I'm just going to write OC for opportunity cost of not repurchasing their own stock. And if they were, kind of holding their own stock, they would be thinking about the dividends that they would be getting on that stock. But there are obviously other implications of, repurchasing stock, which is that a lot of the time, that usually has a positive effect on share price because of earnings per share. There are now less shares outstanding because they've kind of pulled stock back in, what we call treasury stock, and that usually has quite a positive effect on the stock price. But that's really more complicated. So use either of these two ways or both of them in conjunction to try and understand that there is actually a cost of retaining the earnings. You know, like I said, they could have kind of taken that money instead of investing into their own company and invested in another company. So the return that they would have got in investing in another company is a cost to them because it's kind of money that they've given up. Now the whole big idea over here is that these four different costs of capital eventually begin to blend into one main cost of capital, and that is what we call the WACC. And you're going to hear a lot about the WACC if you're in finance. It's first of all one of the most popular interview questions. Could you explain to me a little bit about the WACC or how to calculate the WACC? But the WACC stands for the weighted average cost of capital. And basically how we can view this is, the weighted average cost of capital is basically how much it costs a company to continue to raise capital. So as long as this weighted average cost of capital, or this WACC figure, which comes out as a percentage in the end, as long as this WACC figure is below the rate of return that the company are earning by using all of this capital, then they're in a good space. If their weighted average cost of capital, i.e., the amount of money it costs them to raise money, is more than what they're earning, then what's the point? They may as well have not raised this money. They may as well have not borrowed money or issued preferred stock or common stock or retained their earnings. They may as well have gone out and invested in other companies, or just not taken the loan at all. If the interest rate they're paying on borrowing the money is higher than the amount of money they're making on that borrowed money, or using that borrowed money, then there's just no point at all. So this weighted average cost of capital, the WACC figure, really helps us to determine our required return when we're capital budgeting. We calculate the WACC of how much money it's going to cost us to raise this capital, and then we know that we have to kind of make a return on our investment that is greater than the WACC. So the WACC really kind of sets the bar. It provides us with an indication of how the market is viewing the risk of our assets, the risk of how highly leveraged or how much money we've borrowed, or how much money we've or how much stock we've issued in terms of the market. So it really tells us quite a lot, and it's very commonly used, and the WACC is in every single financial model that is built to assess the valuation, intrinsic valuations of companies relative to market prices, and it's a very important concept. So let's go ahead and calculate the cost of debt, the cost of preferred stock, the cost of common stock, and the cost of retained earnings, and then at the end we'll draw up a little table to calculate how we get to the weighted average cost of capital, and then we'll proceed from there. So let's scroll. And we'll start with number one. Number one is the cost of debt. Now this is the easiest one. The cost of debt is basically, let's just write out the formula for it first. K, this stands for cost because we don't use C. KDAT, and that stands for the cost of debt after tax, and that equals the cost of debt BT before tax multiplied by 1 minus T. Now let's just write out over here that T equals the tax rate of the company, and if you've done basic accounting courses, or a little bit about debt in terms of corporate finance, then you'll know that interest is tax deductible for a company. So let's just say that the cost of debt before tax was 10%. They wouldn't actually be paying 10% on on that bank loan or on those bonds that they issued, simply because interest is tax deductible. So they're actually going to be paying less. So let's just do an example with a bank loan. Let's say the bank are charging 10% interest, and obviously this is all in annual terms, 10% interest, and the company have a tax rate of 40%. So the way to calculate the cost of debt after tax would simply by doing cost of debt after tax equals the cost of debt before tax, well that's 10%, multiplied by 1 minus T, 1 minus the tax rate, which is 40%. and that comes out to 6%. So their actual cost of debt is 6% because 4% of it is being pulled out by um, the tax shield, because interest is tax deductible for the company. Now let's move to a second example of debt. First we have a bank loan, then we'll have a bond. So on a bond, the actual cost and the rate of a bond's yield to maturity is what is taken as the cost of debt before tax. So if you had to calculate from other factors such as PV, FV, I, N, M, all that good stuff, and you came out to a yield to maturity of 10%, that would be your cost of debt before tax, and then you just proceed as you did, over here using the same stuff. I think in the next video we'll deal with the other costs, so we're going to leave it here in terms of the cost of debt.